A central bank is an organization that manages a country or a group of countries' currencies and regulates the money supply. Now, central banks, also known as reserve banks, were established as a result of previous financial booms and busts that included bankruptcy that wiped out people's savings. Now, price stability is a primary goal for many central banks. In some countries, central banks are also required by law to act in support of full employment. The crucial aspect of a central bank is its legal monopoly position, which gives it the right to print money and bank notes. Now, most central banks are not government agencies and are assumed to be politically independent. Is a central bank a commercial bank? Individuals cannot open an account at a central bank or deposit money or even request a loan from it. The central bank conducts monetary policy. They control the amount of money circulating in the economy, set the interest rate applied to loans, and also control the rate of inflation. When price increase, there is inflation, which means a drop in value for the country's currency, and this is also known as a decline in purchasing power. Inflation is a sign of growing economy. High inflation, however, is a problem since it devalues currency and discourages lending and investment, wiping out people's savings in the process. Now, the opposite of inflation is deflation. This is when prices are falling. Now, inflation and deflation are strictly controlled by central banks. A central bank serves as a bank for commercial banks, and in doing so, it influences how money and credits are distributed throughout the economy to maintain stable prices. Now, a central bank is a source of credit for commercial banks, typically to meet short-term needs. They must provide collateral such as government bond or corporate bond to the central bank in order to borrow money from it. Now, the collateral serves as a guarantee that they will repay the loan. Commercial banks may face liquidity problems as a result of lending long-term against short-term deposits. In this scenario, they have enough money to pay off a debt but are unable to quickly convert it into cash. Now, this is where a central bank can step in as a lender of last resort, and this helps the stability of the financial system. In addition to monetary policy, central banks can perform a variety of other duties such as ensuring the smooth functioning of payment system for banks and traded financial instruments, print banknotes and coins, manage foreign reserves, and engage in informing the public about the economy. Now, many central banks also help to maintain the stability of the financial system by regulating commercial banks to make sure they are not taking on too much risk while lending. Now, what really does a central bank do? So, central bank have the power to both boost and slow down economic growth. Now, this is due to the fact that central banks maintain cash reserves from which commercial banks can use to give out loans. Now, the cost of which is determined by national interest rates. When there is high inflation, the central bank can raise interest rates, which makes it more expensive for an individual to take out a loan from the bank. Now, the central bank may stop printing money or compel commercial banks to buy financial instruments such as treasury bills or foreign currencies. Now, which reduces the supply of money in the economy. Now, this is called contractionary money policy. On the other hand, when the economy is slowing, the central bank can lower interest rates, giving commercial banks cheaper access to funds that therefore let individuals and businesses borrow money. Then the central bank may at this point resume printing money, and this is called expansionary money policy. Majority of central banks impose a reserve requirement on commercial banks, which requires them to hold back a certain amount of cash they owe to account holders in the form of dividends. Now, this is to prevent banks from going broke. Now, countries that don't set a reserve requirement like the UK often have capital requirements instead, which are determined by the ratio of a bank's capital to its risk. Now, the central banks and interest rates. The interest rate on your savings account is not directly set by central banks. They rather set an underlying interest rate, or the base rate, which is either the amount that commercial banks are charged to borrow from each other, like in the US, where the Fed sets the federal fund rate, or the amount that commercial banks are charged to borrow from the central bank, like in the UK, where the Bank of England sets the bank rate. Now, why does the central bank change the interest rate? When a central bank cuts interest rate, it is said to be loosening monetary policy or easing. Now, when it increases interest rate, it is called tightening monetary policy or just tightening. Now, when a central bank wants to stimulate the economy, interest rates are lowered. Now, interest rates are raised when it wants to fight inflation caused by an overheating economy. Now, how can interest rate cuts improve the economy? Number one, businesses can borrow money and invest in projects that will earn more than the risk borrowing rates. Number two, the stock market is discounted at a lower rate when interest rates are lower, which results in an increase in stock market prices, which creates a wealth effect. And thirdly, people invest their monies into the economy, which is the stocks and other assets, in order to earn more than from the lower interest rates. If the economic growth is too rapid, inflation becomes too high and chaotic. So due to the uncertainty surrounding price predictions, it is challenging for businesses and households to make long-term plans. Now, this can affect spending, which could also slow growth. Now, in order to prevent this scenario, the central bank will then raise interest rates to try and decrease the rise in spending and bring inflation back under control. So, let's look at the central bank and the forex market. Central banks have a significant impact on the currency market because of their power over monetary policy. Their direct influence over the money supply affects the demand and price of the currency. Now, central banks are able to attempt market manipulations through the use of various policies in order to maintain a certain level for their currency. Now, some countries and their central banks attempt to peg their own currency to another currency or baskets of currencies. China and Hong Kong, for instance, pegged their currencies to the US dollar. So, in order to minimize currency fluctuations, the central bank participates in the forex market by buying and selling their currency at the spot market. Also, to make their local economy more attractive for international trade, central banks have another interest in maintaining the value of the local currency at a specific level. Now, if you find this informing, kindly smash the like button to let us know you want to see more of this content. All right. Now, subscribe and turn on the notification bell so you don't miss out. Leave a comment and let us know what topic you want us to tackle next. Share and keep others informed, as knowledge is power. Until next time, be safe.